When it comes to investing, the biggest risk in 2026 isn't a market crash, it's doing nothing. Inflation quietly eats your money, headlines create confusion, and most people delay investing because they are waiting for the perfect time. But building wealth has never been about predicting the future. It's about having a clear, disciplined strategy that works over time. In this video, we will discuss how to invest in 2026, why investing matters, the right approach to take, the types of investments to focus on, and how to manage risk in an uncertain world. So let's get started. Before we start, there's one question we need to answer first. Why should you invest at all, especially in 2026? Well, the first reason is inflation. Inflation is the silent force working against your money every single year. Even when prices rise slowly, your cash loses purchasing power. Think about everyday costs such as food, rent, transportation, and other costs. What you could afford a few years ago now cost noticeably more. Investing is how you fight back. When you invest in assets that can grow faster than inflation, you are not just protecting your money, you are preserving your future purchasing power. The other reason to invest is to build wealth. Wealth isn't created by saving alone. Saving protects money, investing grows it. When your investment starts generating returns, those returns begins to compound, meaning your money starts working for you. Over time, this creates a powerful snowball effect where growth accelerates not because you invest more, because your capital is expanding. This is why people who own assets tend to pull ahead financially, while those who rely only on single income struggle to keep up. In 2026, investing isn't about getting rich quickly, it's about staying financially relevant in a world where costs keep rising and stability comes from ownership, not just earning. Once you understand why you are investing, the next question is how to do it correctly. The most important rule in investing is this: think long term. Markets move up and down in the short run, but over long periods, they reward patience. Trying to predict short term movements or time the market usually leads to poor decisions. That's why your approach should focus on fundamentals, investing in strong businesses and broad markets, not chasing price chart or trends. And instead of waiting for the perfect moment, build the habit of investing consistently. Putting in a fixed amount at regular intervals, regardless of market conditions, remove emotion from the process and lowers the risk of bad timing. In 2026, the winning approach isn't being faster than everyone else, it's being disciplined, consistent, and patient. Now that you know why to invest and how to approach it, the next question is what should you invest in? Let's start with stocks. Stocks give you ownership in individual companies and the potential for high returns. When a company grows, your investment grows too. But picking individual stocks comes with a higher risk. Some companies succeed spectacularly while others may fail. That's why stocks are usually best as a part of a larger diversified portfolio. To reduce risk while still participating in growth, many investors use mutual funds. These pool money from many investors to buy a collection of stocks or bonds. The benefit is simple: diversification. Instead of betting on a single company, you own a mix of companies, spreading your risk across the market. Mutual funds are managed by professionals, which makes them ideal for investors who want growth without constantly analyzing every stock. Then there are index funds and ETFs, probably the simplest and most reliable choice for long-term investors. These funds track a broad market index like the S&P 500, meaning you own a piece of hundreds of companies at once. This provides instant diversification, low costs, and historically steady growth without the stress of picking winners or timing the market. ETFs are traded like stocks, so they are flexible and accessible to any investor. The beauty of the combining these four types, individual stocks for opportunity, mutual funds for managed diversification, and index fund or ETF for broad, lower cost exposure, is that you create a portfolio that can grow steadily over time while managing risk. In 2026, This approach matters more than trying to chase the next hot stock or trendy sector. By focusing on these core investment vehicles, you are building a portfolio that is resilient, diversified, and designed for long-term wealth creation no matter how the market shifts. Finally, talking about risk management, first understand time versus timing. Trying to time the market to buy at the perfect low and sell at the perfect high is a losing game for most investors. Instead, focus on time in the market. The longer your money stays invested, the more it benefits from growth and compounding. History shows that patience almost always beats timing. Second, know your risk profile and time horizon. Everyone has a different financial goals and comfort levels. If you are investing for a retirement 30 years from now, you can tolerate more volatility and lean more heavily into growth assets like stock or ETF. But if your goal is short term, say 2 to 3 years, you will want safer, lower volatility investments such as bonds and debt funds. Aligning risk with your goals ensure you can stay invested without panic selling. Third, learn to manage emotion and filter news. Markets will fluctuate and headlines will often scream crisis or opportunity. Reacting emotionally to news, buying during hype or selling in panic destroy returns. A disciplined investor sticks to their strategy, invests consistently, and ignores the noise. Tools like automated monthly investment or dollar cost averaging makes it easier to stay on track without letting emotion take over. By combining patience, goal-based risk alignment, and emotional discipline, you protect both your capital and your peace of mind. In 2026, this is how you turn market volatility from a threat into opportunity. Finally, investing in 2026 doesn't have to be complicated or intimidating. We have covered the four main points that make it practical and effective. First, why invest? To counter inflation and build long-term wealth. Second, investment approach. Stay disciplined, patient, and consistent. Third, investment type. To focus on stocks, mutual funds, index funds, and ETFs to create a balanced, diversified portfolio. And fourth, risk management. To let time work for you, align risk with your goals, and manage emotions in the face of news and market swings. The common thread is clear. Success comes from clarity, consistency, and discipline. 2026 isn't about chasing trends or reacting to headlines. It's about making intentional choices that grows your wealth steadily over time. Start now, stay consistent, and let your investment work for you. The future belongs to those who act thoughtfully today. If this video helped you, then make sure you hit the like button, share the video, and subscribe so you don't miss the next deep dive we are working on. Thanks for watching, and I will see you in the next one.